Hello, everyone. Welcome. We can talk about the winners and losers in this housing market. My name is Seewing Yee from the University Network, and my co-host is Mr. Richard Advani from Guarantee Rate Mortgage. How are you, Richard?
Doing great. How are you?
Very good, very good. Thank you. Thank you for your time to do a presentation. So let me start by posing this scenario and this question, which is a real life scenario, and we could call it winners and losers in the housing market, for lack of better term. So let's recap what transpired in the past 3 years. Okay, in 2021 to 2022, my investment group, no other than several investment group that you work with, Richard, in other part of the country, where I have about 1,000 of my members within my network. And you work with other investment group that have like 50,000 members within their network. At the end of the day, we say human behavior is very similar. These investors were exposed to investment opportunities on a weekly basis, right? We provide free education, a lot of opportunities every week that comes into this email inbox of these investors, and they analyze it and they do what they do. They don't do. Sometimes I consult with these people, I qualify these people, and I encourage them to take action at any given time. And most do not take action. Of course, you and I know, right? It's human nature, right? Anyway, so let's go over the recap. 2020 and 2021, during the pandemic, the mortgage rate will decrease to like 3 to 4%, 30-year fixed rate mortgage. So pandemonium, real estate boom, the whole 9 yards. Okay. And of course, you and I, we promote in the best affordable markets, cash flow, turnkey, Florida, Texas, North Carolina, Alabama, Tennessee, and Midwest, just to name a few. Okay. So at that time, the rental homes that at least I'm promoting, you were also consulting with the investors with their loans, similar situation all across the country. The homes I was exposing to our investors, single family home, many of them were new construction, single family home, around $150,000 a couple of years ago, 2.5, maybe 3 years ago, depends on which market. But I'm just $150,000 rental homes, rents for about 1,300 on the average. So thousands of our investors were exposed to these opportunities. Some purchased, most did not. Fast forward to today, the first quarter of 2024, the mortgage rate has went up as much as 8% a few months ago in November, I think. Now it's back down to the mid 6%. Fine. And then those homes that I was promoting, 150K on the average, many of those homes 3 years later today, from 2020, 2021, that many of them were increased in value like 50 to 100%. You experience it now, Richard, right? You consulted with many investors over the past decades, and especially the past 2 years. Those homes that were promoted, that many of our investors didn't buy at 150K, today they are around 250 to $300,000, essentially double in value. Not just that, the rents that they were collecting, the people that bought around 1,300 at that time, they increase the rental income they're collecting increased from 1,300 on the average to like 16, 17, 1,800, as much as $2,000 today. All right, those are the missed opportunities. It's a vicious cycle. Every year, every situation. We can go back. You and I, right? We've been doing this for more than 10 years. We can go back 10 years ago when the homes were $50 to $100,000. Those cash flow turnkey opportunities. Now those $50 to $100,000 home were now, fast forward 14 years later, is like $300 to $400,000, and the rent has gone up. That's the bottom line. So why don't you finish up the recap for the next 5 minutes or less, and what's your takeaway on it? Who are the winners and losers in the past 3 years? And by the way, those people, look, you and I should not waste our time. The people that did not buy when you and I worked with them very closely 3 years ago, when the price was 150K, what made you and I think those same investors that chose not to trigger, not to buy at that time 3 years ago, what made you think they're going to buy now when the investment houses have increased 50 to 100%. Human behavior, most of them will not change. Anyway, some did. Congratulations. So some of you that just did it. And so that's my takeaway. Go ahead, finish up my recap.
Yeah, I think you hit the nail on the head with whoever sat on the sidelines. And this is in life. This is with any investments, right? Whether it's real estate or stocks or whatever it may be. Most people get stuck in analysis paralysis, or even worse, they try to time the market. And even Warren Buffett and Ray Dalio will say, don't try to time the market, right? Dollar cost average. Always be buying, and then you're going to buy high, you're going to buy low. But historically and statistically, you're going to build more wealth that way because number one, you're going to take action. Number two, you're actually going to buy at different price points, right? So you're going to take advantage of the low points. You're going to still buy at high points. But also, we also have to look at just real estate decade over decade, right? People didn't buy. I know people that stopped buying in, I think, 2014 or 15, right? Almost 10 years ago, because real estate was on an upward run for like 7, 8, 9, 10 years. And everyone was like, hey, you know what? Real estate is a cyclical and every 10 years. And they ignored a lot of the fundamentals, but they just were like, hey, everyone was still a little sore and bruised from what happened in 2007, 2008. A lot of these people sat on the sidelines. And then leading up to COVID, a lot of those same people thought they made the right decision because they're like, hey, you know what? It's going to come down now with COVID and rent relief and all these things. And what ended up happening, right? Those of us that took action know prices went up sharply, rents went up sharply, and inflation's gone rampant since. Things have only gone up. And the problem, though, like you said, is with human nature. Most people that didn't buy in the last 6, 7, 8, 9 years because they're trying to time it or they're waiting for the perfect time, most of them are probably going to use that still logic, right? And say, hey, you know what? Now I really missed it. Okay. I thought I missed it last time. It went up more. Now I really missed it. And I'm going to wait for them to come down again. And the sad thing is that's most people, right? They don't learn from what they just experienced. Like, hey, that was not a good decision to sit on the sidelines. And also, look, you don't have to be a brilliant financial analyst or professor to know simple supply and demand, right? There's more people, there's more families and households than there are homes. And currently, nationally, we're not building enough homes to start going the other direction, right? To where there's an oversupply. And I think the federal government statistics is like 10 years. If we started building what we needed to, it's going to take 10 years to unbury from that hole. Look at the fundamentals. Look at inflation. Inflation is always going to be here. The target's 2 to 3%. So what does that mean? 10 years later, whatever asset you buy is going to be worth 30% more. Rents are going to be 30% more at a minimum, right? We've seen 100%, but at a minimum, just looking at that, looking at a modest depreciation rate of 2 to 3%, setting cash flow aside, you're still going to build significant wealth on a 5 to 10 year plan, regardless of what happens with values, regardless of if they dip down a little, which everyone thought last year was going to be the year that happened. Excuse me. And I think nationally, we finished up still 1% or 2%. Some markets were up a lot more than that. Some markets were down 4 or 5%, but nationally, we leveled out. So if you look at things, we're at a healthy point right now. Now, look, don't get me wrong. Everything's way too expensive, right? Groceries are way too expensive. Houses are way too expensive. That's inflation, right? We're not here talking about inflation right now. We're here talking about everything's affected by that. The notion that there's going to be some huge reduction in house values. The US right now, the average person is sitting on historically more equity than they've ever sat on before, ever. So if you listen to the doom and gloomers, like, oh, the next foreclosure wave, look, if you owe $400,000 on your $800,000 house and you can't make your payments, you're not going to let your home go into foreclosure, right? You're going to sell it, maybe a little under market, but you have tons of equity. And that example, there's probably the average example for most people in the country. They have 50% loan to value. What happened in 2008 was people were upside down because they had cashed out and used their homes as piggy banks. Guess what? We learned as a society. We haven't done that this time. Partly because our rates are so low on our conventional 30-year fix that it'd be silly to refinance a 2.5 or 3.5% loan. Hopefully the smart ones out there will learn from what they just experienced and not continue the same path of just sitting on the sidelines. And when it comes to dollar cost averaging, again, look, if you have enough money to buy 2 or 3 rentals, we're not saying run out and buy all 3 right away. Dollar cost average, go buy one now, right? Let the dust settle, collect rent 4 to 5 months later, go buy another one, right? Let the dust settle, or whenever. Look, we'll sit down with you and figure out your particular objective, but instead of 4 to 5 months, maybe it's a year, right? But you wait for a short period of time, then you buy the next one. And then you rent that out. You wait for a short period of time, you buy the next one. So your dollar cost averaging also. But if you look at that timeline, let's say you had enough money to buy 3 properties. If you bought them 3-4 month gaps, that's a year out, right? You would have bought the last one a year out. And I'm sure most of you in your heads are like, well, the next year or 2, things may move down. Well, they move down, guess what? Then you're going to get a smoking deal on your third of the 3 that you were buying. But if they don't, like they haven't thus far, you've made massive action, right? You've already purchased some properties and purchased things that make sense for you. The inaction isn't helping. And I feel bad for you if you did have the money sitting in a CD or whatever, earning, even if it's 5%, you're like, I get 5% in my CD. I'm like, great, the inflation is 30%. You just lost a third of your money in the last 2 years. And people actually, look, before it was just words, now people actually like, yeah, you're right. So I'm like, that 100 grand, how much groceries could you buy with that 100 grand 3 years ago, right? Now go take that same 100 grand or 1,000 if you want to scale it down and go buy groceries. You've lost at least 30% of your buying power in any cash you had sitting there. Whereas in real estate, guess what? You would have been locked in a 30-year fixed, even if 30 was 6.5, whatever, 7. You would have been locked in on a 30-year fixed. And guess what? Your tenant's groceries would have gone up. Your tenant's gas would have gone up, and your tenant's rent would have gone up. And you would have been the benefactor of that, right? Of the rent going up. Yeah. Whoever owns real estate, it's where you don't need to, they'll just fast forward through all of this. They're like, we know, we just experienced it, right? Whoever on the sidelines saw all that growth, rent appreciation and all that. When you're on the sidelines seeing all that, you're like, wow, maybe I missed it. We didn't, and we did experience it. And it's cool because properties you buy at $200 a month cash flow, 8 years, 9 years later, rents go up $300-$400. Now your cash flow is $600 a month, right? The rent doesn't need to double for your cash flow to double, guys. You just need to increase the rent, and all that's gravy to you. And conservative rent increases over 7 or 8 years. My property went from renting at $1,395 to $1,795. So I went making $200 cash flow to $600 cash flow, from 7% ROI to 25% ROI. And that's not even including the fact the property is appreciated. That's not even including the fact that the return on amortization, because we pay down the balance now as well, and I'm aggressively paying it down 8-10 years in. But anyways, I rest my case.
Yeah, you have a nice recap. So let's do another scenario. Starting today, 2024, the first quarter of 2024, my investment opportunities available within my network are really very similar to the investors you come across when you do their loans. So let's run this scenario. Currently, we have great high cash flows in the Midwest market. For example, Buffalo and Niagara Falls, and the homes are selling for like 60 to 100 grand, single family home duplex. Even with a 7% mortgage rate, you can still cash flow $200, $300, $400, $500 net cash flow at 25% down payment. And then the houses in new construction in the South and Southeast, mainly Florida and Texas, the opportunities were single family home, $250K, for example. You raise for $1,700 right now, typical scenario. And then the mortgage rate buy down, you and I talk about the builder incentive, the rate buy now is at the low 5%. You can cash flow right now at $200 on those fast growing new construction and path of growth in many submarkets in Florida and in Texas. You and I run across these opportunities every day right now, even under current environment. So let's fast forward 5 to 10 years. The few that are buying right now, they are the winners of them moving forward 5 to 10 years later. From today, for those people, once again, it's a vicious cycle, human behavior. The most people, for whatever reason, even though they qualify financially with the credit and everything else, down payment and all that, they still cannot pull the trigger. So 5 to 10 years from now, for those people that did not purchase today on this still great opportunities under the current environment, what are the regrets? What are they saying 5 to 10 years from now about today? on something they did not pull the trigger. As you talk it through, what they think in 5, 10 years from now.
You're talking about a future scenario where they didn't buy?
Yeah, opportunities that are before them right now, based on the nice cash flow properties with the building incentive, whatever, still cash flow, even if at a mortgage rate 5.5% or 6% with a late buy down, cash flow opportunities. Where people continue to sit on the sideline, they look at these kind of opportunities. They still, for whatever reason, did not pull the trigger.
There's no question that we're heading towards a renter's nation, right? And the question is, what side of the equation do you want to fall on, right? Do you want to be a landlord? Do you want to be a renter? Have you realized what all the biggest hedge funds and huge companies out there like BlackRock have realized, which is single family homes and multi to 2 to 4 year homes are the biggest wealth builder in the long term in the United States, right? All the people way smarter than you and I have realized that. So I think if you sit on the sidelines, you're going to be writing a check to BlackRock at some time in the future, or maybe some private landlords like myself or one of the investors that are buying. But there's no question about where we're heading. Now, do I think it's right or wrong? I'll spare my judgment on that. But what I do know is it's happening. And I want to fall on the side of the equation that owns lots of real estate and benefits from renters nation versus is one of the ones paying into it.
Yeah, exactly. Thank you so much, Richard Advani, and your contact information and at the bottom of the description. So anyway, my name is Seewing Yee. Thanks for watching. I will see you on the next video.